All right, we're good to go.
Great, thank you. All right, so let's see if I can get my slide deck moving here. Here we go. Maybe? Yes. All right. All right, so this topic is investing for beginners, right? I will say that some of the things that I included in the slide deck maybe are slightly more advanced than I normally would do, just in an effort to kind of cover as much as we can, because it's been kind of an exciting year in investing, or exciting month in investing. There's always these kind of disclaimers that I have to list ahead of time, right? So certainly when I send out the slide deck, look at those in detail. One of the main things that is expressed here in all of these disclaimers is past performance is not indicative of future results. So again, I know that those of you who kind of tune into these meetings have heard this before, but I'm going to say it again, just for the room. When we're talking about finance and investing, we're looking forward into the future, right? We're trying to make decisions about where to allocate our money in the future. But we don't know what the future is going to be like. So we rely on data and information from the past in order to inform those decisions about the future. But obviously, the future is not going to be exactly like the past, right? So, I have some charts in here that are meant to, you're meant to look at them and use them as information to make forecasts or predictions about the future, while understanding that it's not going to be exactly the same, right? Like every time I say that out loud, I'm like, okay, that's probably obvious to everybody, but still we say it, right? Here's a little bit about me. I'm not going to spend too much time on this. I'm assuming if you want to, look at my CV, you can find me on LinkedIn and link in with me. And then we'll just go ahead and get started. Okay, so we're here to talk about investing for beginners. So let's start with the super basics, like what is investing, right? We're talking about putting time, effort, and money, right, is usually what we're talking about, into something today with the expectation, but not a guarantee that we'll get profits, gains, and or income in the future, right? So again, back to that concept that we're taking this imperfect information that we have today and trying to figure out how to put our money in the best place to work for us in the future. This not a guarantee part is also very important, right? If you want to guarantee that you will not lose money, you can get that in a couple places. You can put your money in an FDIC insured bank account, right? Or you can buy an insurance contract in the form of an annuity or something like that from an insurance company. That insurance company will give you a guarantee. The FDIC insurance at your saving or at your bank will give you the guarantee that you will not lose money. But that's not what we're talking about here. Here we're talking about taking some amount of risk with the expectation that we'll get more by doing that. I mean, I think we all know in your savings account, in your checking account, in your short-term and even kind of long-term CDs at the bank, in exchange for that guarantee, you get basically no return, right? Like if you might have a savings account that returns, maybe if you're working really hard, maybe like 0.25% per year, maybe 0.5% per year. I don't know, those days might be gone. Most of us, I think at especially larger banks, you're probably getting something like 0.01% on your savings. So the money's perfectly safe, right? Because of the FDIC insurance, but you don't get anything in return. So here with investing, we're trying to do something a little different. We know that we're taking this money out of this ultra safe space and we're investing it in something that we hope will grow more than that in the future, because most of us need that. We need to be growing our wealth over time. Certainly, whenever I'm talking about investing, I'm keeping my eye on the prize for long-term goals, like retirement, or like getting to retirement age, or if you're at retirement age, getting through retirement, which for most people we hope and expect will be a long period of time. It can also be for kids' college expenses. To me, one of the questions that comes up quite a bit is like, what do I consider long-term? I consider 10 years plus long-term, maybe 5-ish years. That's really kind of medium term, but maybe if you want to be really aggressive with what you consider long-term, you can say like a 5 to 10 year time horizon also qualifies. So that's what I'm saying when I'm thinking about long-term investing and trying to figure out where can I put this money today that I have the savings, where can I put it so that it turns into more money over the next 10 years or 20 years or 30 years. I think, you know, some of you who've been to meetings before know this is one of my favorite Warren Buffett quotes, and we're always talking about Warren Buffett and Warren Buffett quotes in these meetings, right? But I like this one: risk comes from not knowing what you're doing. I think that's where a lot of people feel their risk is when they talk about investing, right? Like, how many times have I heard people say, like, I don't know what I'm doing, right? And no one is telling me, and it's really confusing, and I'm making these decisions without knowing why or, you know, what the background is. And so that's what the whole purpose of this group is, right? Is to figure out what you're doing, and to figure out what you're doing in regards to you and your own personal goals, right? So we're trying to make it really personal, and not just always be talking about like what the markets do, right? Like we need to figure out what you want to do. And so I think, like, if I try to make it really simple, I think that there's really only 3 steps to being a good investor. The first one is save money. Next month, so our March 2021 meeting, Sandy Coco, I think, is going to do the topic on budgeting, right? So the idea is you make some money, you spend some money, there needs to be money left over at the end of the month or the year or whatever. So we are actually going to cover this topic next month. So I'm not going to spend too much time on it. So once you have money that you have saved, then we try to figure out where to invest it, right? And so we're trying to figure out the right mix of risk and expected return. And we're trying to invest for a long time, right? So again, if we can get like past 10 years for some of this money, it actually makes investing a lot easier. The third thing is control your emotions. This is often the hardest part of investing, right? And some people are just going to have a much harder time than other people. So you kind of have to know yourself with number 3 here. How anxious are you? How anxious are you about the markets? You know, what's your relationship with money? What's your relationship with investing, right? It's going to be really personal, but even for those of us who are really risk tolerant, it is painful to go through, especially stock market crashes, right? It's just painful. So the best time to figure out what you're going to do when the stock market crashes, the best time to figure that out is ahead of time, so that you can just be ready, right? Like, okay, I know that I'm going to be very anxious about this, and you can develop a strategy, right? Like, some of the best strategies that I've seen people in this group and, you know, some of my clients do is just ignore it, right? I'm in it for the long run. I'm not even going to look at it. I'm not going to open my statements. I'm not going to check it. I know it's bad, and I'm not going to put myself through that pain, right? But you're going to have to figure out for yourself, you know, how to get as far out on the risk spectrum as you can go, and then hang in there when things get tough, because they will always get tough. So just we can't get around that. So the controlling the emotions part is really tough. But maybe the most important part of this whole thing. The fundamentals of investing in 2021. So this is where I'm just going to kind of talk about some themes that I think for 2021 are going to be important to keep in mind. This might be a little bit beyond like the ultra basics for beginners, but I just wanted to touch on it anyway, because a lot of people have been asking me a lot of questions about, you know, my outlook or, you know, people's outlook for 2021. And I think that there are like kind of these 4 major trends that are in place for 2021. So I just want to run through those first before we go into the next piece. The first one is don't fight the Fed. What we mean by don't fight the Fed is that the Federal Reserve, which is like the head bankers of the whole US financial system, they have reduced those interest rates on your savings accounts all the way back down to 0, right? And so when they do that, they create this atmosphere of pain for people, right? How long can you keep your investments or your savings at 0%, right? People have a different tolerance for pain here, but, you know, one of the acronyms we use for this phenomenon is TINA. There is no alternative, right? Most people just can't for a long period of time accept keeping cash in a 0% interest rate savings account. So they will go out and either spend it or invest it in something riskier. And what that does is it pushes cash into our economic system in some way. And that called velocity of money, the number of times that money changes hands, we need that to be moving in order for our economy to work. Like, imagine that if everyone took cash out of the system at the same time, what would happen, right? Like, if I take my money and I spend it at a store, my money turns into a paycheck for someone else. And then they take their paycheck and they spend it, and it turns into a paycheck for someone else, right? This is how the economy works. So that's what the Federal Reserve is trying to do here, right? And they're pretty transparent about it. It's not like a trick, but be aware of it. The Federal Reserve has said since last March, they're going to keep rates really low. So if you're waiting to get back to that 2% rate on your savings account, you're going to be waiting for a long time, right? Years, like maybe through 2023 or 2024. And so it's important to know that. Low rates are bad for lenders or bad for savers, but good for borrowers. Those of us who are in the Austin area kind of know that this really manifests itself in form of low interest rates on mortgages, which then means that prices for housing go up, right? Because people can afford to borrow more at low rates. This is a phenomenon that's probably going to stay in place for a while. So again, for people who are like waiting for their interest rates on their short-term savings to go back up, you're going to be waiting a while. So, and that might be fine for you, but just know that's the way it's going to be. The second thing, again, this is not rocket science, right? The economic recovery should mean more money in people's pockets. As the vaccine rollout continues to happen, like now all of a sudden I'm meeting more and more people who are vaccinated, right? Which makes me feel relieved, makes them feel relieved. It makes people able to go out into the world and do things that they couldn't do a year ago, right? So that reopening of the economy trend is still in its early stages, and everyone expects this to happen through 2021, right? There might be setbacks. It might not happen as quickly or seamlessly as we all hope, but it's still happening, right? And that is really kind of the main driver of the economy. Stimulus is probably going to get pushed through here in the next few weeks. And so that will mean more checks in the hands of more people. When people get money, especially people in lower income brackets, they tend to get the money and then spend it. Again, that's what gets an economy moving. So this is all relatively good news. Our gross domestic product in the US is just about 70% consumer driven. So when consumers have jobs or consumers have money, it leads to economic growth. In the markets and in the economy, I think there's these secular trends that are still in play, right? Like, being in Austin, I try to go to South by Southwest every year, and like it's like the word that I just can't handle like hearing anymore is this word disruption, right? It's like the South by Southwest buzzword. It's like, everything's being disrupted, right? But it's true, right? You have all this technological innovation, these digitally native companies coming online and disrupting certain sectors of the market. Maybe the most obvious one is kind of the gas-powered fossil fuel industries. And now we have electric vehicles coming in and starting to take customers away from fossil fuel, right? That's by secular we mean long-term, like a secular trend that is gaining momentum. Another one is many people have digital wallets now, right? Maybe use Venmo or PayPal or something like that, the Cash App. We do more on our phones in regards to banking than we ever have before. And so we have fintech, financial technology, disrupting traditional banking sectors. So these are all things that are still happening, even post-COVID, right? There are these long-term trends that we expect to play out over time. And maybe the way to think about it is, how are people voting with their dollars, right? That changes over time, but if you think about the way you spend money and the goods and services that you use and that you want to use in the future and that make your life better or solve problems, it can probably lead you to some long-term investing decisions. And then the fourth one, I just added this one based on last month's GameStop, Robinhood debacle, saga, I don't know, whatever's happening, right, is the rise of the retail investor. And so certainly we can talk more about GameStop if y'all want to. Just drop what your actual questions are in the chat box, and hopefully we can circle back around to it towards the end. Like if you want to know like what happened with GameStop. But the idea is that with companies like Robinhood, and even with companies like Schwab and Fidelity going to $0 trades, now more of us, right, or more people who are non-professionals, I'm a professional investor, but for more people who are non-professionals, you can pretty easily kind of invest from your phone or from your desktop, however it is. And that phenomenon really blew up in a big way with this GameStop thing and this meme investing phenomenon that happened last month. So I think that that's here to stay. It's probably because it's getting easier and easier for us to participate, whether that's good or bad. Certainly it cuts both ways. I love the democratization of investing, right? Again, that's what the Ostrom's Investing Group is all about. But it is, it does cut both ways, right? There are risks when you gamify investing. There are risks inherent in that and making it feel like gambling or making it feel like a game when we're actually talking about real money. And there's a way for you to really set yourself up for some pretty rough risks. So I think that that is going to continue and be something that maybe we address more and more here. Certainly with GameStop, Robinhood, meme investing, all of this, that falls, in my mind, I differentiate very much between this long-term investing that I talked about at the beginning and short-term trading, right? Trading is highly speculative. It is very difficult to make money doing short-term trading. We don't talk about it that much here, but every once in a while we cover it. Again, certainly, because this is investing for beginners, I am going to kind of gloss over it for now and come back to it later for those reasons. All right. I'm going to keep going. Gwen, should I stop or should I keep going?
I think we can keep going for now.
Okay, cool. All right. Let's talk really quickly about the two main ways that investments make money. So your total return, the total amount of your return on investment, the total amount of money that you make on an investment is really made up of these two components. One is the change in price. And I always do this triangle thing with my hand. I'm trying to show the delta, right? The change in price. So you buy something for $100 and you sell it for $150. You made $50 on that transaction. So that's a change in price. Prices can go up and you can have a positive return. Prices can go down and you have a negative return. So that's the first big component of investing. Different investments have different expected changes in price. Some investments are very stable, so their change in price might not be very much. Something like stocks, the change in price is the majority of the return. That's where we get most of our gains or losses, is in that change in price. The next component, depending on what you're investing in, is income received. So when we're talking about stocks, some stocks, not all stocks, but some stocks pay a dividend, which is a cash payment from the company that you're buying to the shareholder. So Apple pays a dividend. Microsoft pays a dividend. Johnson & Johnson pays a dividend. But not all companies pay dividends. When you're investing in real estate, income received is like your net of expenses, the net rent that you receive. So here, there's kind of a difference between these two asset classes too. With stocks, your income received is either zero or positive. You never have to pay the company more money, right? They only pay you. The income received goes one way. With real estate, that's not necessarily the case, right? You can definitely be cash flow negative on a piece of real estate that you're renting out. So if you buy a house and you rent it out to someone, and the rent does not cover the cost of the house, the mortgage or the expenses or the repairs, then that income received piece is negative for some period of time. But we're looking at these two pieces together to try to figure out what our total return is. So when we're talking about price, the price of an asset, so first I'll stop and say an asset is something that we own that we expect to increase in value. So I'm not talking about cars, they decline in value. I'm not talking about phones or computers or anything like that. I'm talking about something that we own that we expect to increase in value. The price of that asset is simply where a buyer and a seller agree to make a transaction. That's what a price is. So when I'm talking about the change in price, talking about the price that you paid someone for it and the price where someone agrees to buy it from you. That's how prices work. There's no third party setting the price in our system, right? It's all free markets. You have to have a willing buyer and a willing seller agree on the price, and that's what the price of the asset is. Asset prices, regardless of whether they're talking about the stock market, the bond market, real estate, Bitcoin, whatever, asset prices are always changing because investors' expectations about the future are always changing. So tying this back to the very beginning, we are trying to make decisions about where to put our money. Everyone is doing that. That's what we're all doing. We're all doing it together. And so depending on the new information that is coming at us every day or every week or every year, we might change our mind based on what we think is a good investment for the next 1 year or the next 10 years. And everybody is doing that. So asset prices change all the time because our expectations about the future are always changing. Down here, this is where I talked about how many assets also generate income, right? So that's the second piece of our equation up at the top. And then we already talked about the negative income that you could have when investing in real estate. But hopefully this kind of makes sense. There really kind of are these two components when investing that you need to be thinking of. Any questions on that?
We're still good.
Good, I'm gonna keep going. Okay, so now choosing investments. This is really kind of where people get, kind of start getting hung up, right? Like you kind of go through like, okay, I saved the money and I know I want to invest, but what do I invest in, right? Like it's the $1 million question. I think you can start with asking yourself two questions and it will lead you down the right path that works for you. First, when do you need the money? So this money that you've saved, when are you going to come back to use it? It makes a really big difference. If you've saved up this money and you already think you're going to use it for a down payment on a house, the places where you can keep that money between now and when you make the down payment, your choices should be pretty limited. Whereas if you saved this money and you're not going to come back to it for retirement in 30 years, now you have a wider range of options to choose from. So when do I need the money? If you need the money in a relatively short amount of time, so for an emergency fund, making a down payment on a house, paying expenses, paying for kids' college in the next few years, you really need that money to be safe, right? You don't want to come back for the money and have it be worth 20% less than what you expected it. So it needs to be in something safe. If you have a longer time horizon, you might be able to invest it in something that has more volatility, so more ups and downs, but a higher expected long-term rate of return. And we'll talk more about that I have some charts on that. The second one is, can you tolerate big swings in price? This is super personal. It's personal to you. It might matter how old you are, maybe, but I've met people, in their 80s who can tolerate big swings in price and 20-year-olds who can't, right? So it is very specific to you. If you buy something for $100 and a week later, the new price for that thing is $80, what are you going to do, right? Some people will be like, I'm just gonna wait for it to go back up to 100 and then, hopefully keep increasing. And some people are like, oh my gosh, that would make me sick. I would sell it and I would never invest again, right? So you have to know this about yourself because you don't want to be in those asset classes that can fall by that much, because I can not guarantee, but I suspect what will happen is when there's a decline, you will be sad and you will sell that thing at a loss, right? And we do want to try to prevent that. So just know yourself with this, and your risk tolerance can change over time, right? You can become more risk tolerant, you can become less risk tolerant, but just know yourself and ask yourself these two questions. Something like stocks have higher returns over time, but the price bounces around a lot. That's the volatility that I'm talking about. Where is the stock market going to be on Monday? Who knows? It might be up, or it might be down, or it might be sideways. Nobody knows. Something like bonds have lower returns over time, but their prices are more stable. So those are just kind of two of the main asset classes that we're going to talk about most of the time here, and that we talk about most of the time in the Osterman's investing group. So which one sounds better to you? Do you want things to be more stable? You are going to have to give up returns for stability. Or is your goal to make as much money as you can? Then you're going to have to withstand the volatility that increases and decreases in price in order to get to those higher rates of return. This is just the fundamental trade-off in investing. Real estate as an investment can have relatively high rates of return over time if purchased, financed, and managed properly. So real estate can fall into either of those categories depending on how you do it. And you figure out, again, what percentage of stocks, high risk, high return, versus bonds, low risk, low return. I should have put cash in here versus cash. No risk, no return, and real estate makes the most sense for you. And here's just a little chart that kind of shows this relationship between risk and return. So here we're looking at the time period from 1995 until the end of last year, end of 2020. And what we have on the y-axis, is that the up and down axis? All of you engineers or whoever you are. Yes, the y-axis going up and down. Compound annual return expressed as a percentage. This is our rate of return over time on the y-axis. And then on the x-axis going across, we have something called standard deviation of annual returns. So in investing, this is our measure of, one of our measures of risk. It's measuring based on your expectations for how much something is going to return. What are your actual results from year to year? So with stocks over here, over a long period of time, over that, what, 25, 35, however many years that is, 25-year time period, 35-year time period, oh my gosh. Compound annual returns, we expect stocks to return something like 10%, that's this gray line here, but what we actually get from year to year is a lot of volatility. The stock market almost never returns 10%. It's up 25% like over the last year, or it's down 25% like it was in March of 2020, right? So your actual returns are in this really, really wide range. So that's volatile, right? Like pick a spot between up 25% and down 25%, and that should be your expectation over the next year. If we can get through those short-term up and downs, the idea is that if we can hang on, it'll average out to somewhere, 8, 9, 10% per year. But you have to get through the ups and downs. Down here in the bottom left-hand corner, we have cash. We're very low on the risk spectrum. There's basically like no volatility with cash. But we have very low rates of return. So this is showing 2%. This data goes all the way back to 1995, so it includes a big chunk of time where savings accounts did pay more than 2%. But I think, we already kind of talked about this, like the expectation right this very second is that cash, very low risk, but now it's way down here, kind of towards zero. But this relationship, if you look at the chart, the relationship is if you want higher rates of return, you need to go out on the risk spectrum. There's no such thing as a low risk, high return asset class. Now, there is a such thing as a high risk, low return asset class. So over here we have non-US stocks. So these are international companies that you own from the perspective of a US investor. So companies based overseas. Here we can see that we were taking a lot of risk. We had a lot of volatility, but we didn't get the same return as we did focusing on US stocks up here. And way over here, this sad diamond over here below the axis, this is commodities. So these are raw materials. So in Texas, you know, it's oil and gas, but it's also other things like timber and soybeans and things like that. Things that get used up to make something else. They get used up and consumed. Commodities, super risky. Their price is bouncing around all the time. Those of us in Texas, you know the boom and bust cycle of oil and gas. And over that time period, if you had just held on to oil, for example, that whole time period, you would have a negative return, right? So that risk return profile does not look great for a long-term investor. Here in the upper right-hand corner, we have large US stocks. So this is the S&P 500. When you hear people talking about the S&P 500, that's this diamond, large US stocks, small US stocks. Over this period of time, a little bit lower return, but basically the same amount of risk. And then I just want to clarify that this diamond here that says real estate is commercial real estate, not residential real estate, and not your home, not your homestead. It's commercial real estate. So high risk, high return. You know, commercial real estate also tends to be kind of boom and bust. Okay, so this was a lot. Do we have any questions on the risk and return expectations for different asset classes, or just that relationship? Don't expect a high rate of return if you're not taking any risk.
So we do have a couple of questions that I think we can stop for with this slide. So the first one that I want to punt to you, Sarah, is does inflation have a major effect on the returns that are shown here?
Yeah, inflation is a great question. So inflation is not shown here. These rates of return are what are called nominal rates of return. So just when you do the math of the returns, it's the number that gets spit out. But in our lives, we have to adjust rates of return for inflation because we're all experiencing inflation in some way. Over this period of time, the average rate of inflation was something like 2.5% to 3% per year. So what you can do is you calculate the real rate of return on your investments. And so the way that works is, okay, for large US stocks, let's say this is not a 9.5, I'm just kind of eyeballing it, like a 9.5% nominal rate of return. But let's estimate that inflation over that time period was 2.5%. That means the real rate of return, the real increase in growth outside of inflation was 7% per year. Now let's contrast that with cash. Cash was at a 2% nominal rate of return. And so if you got a 2% rate of return on your cash and inflation was at 2.5%, your real rate of return is negative 0.5%. So this is that idea of, okay, keeping your money in cash, you are incredibly susceptible to losing money via inflation. Cash rarely keeps pace with inflation. You're losing purchasing power every year or most years by keeping your money in cash. Most of us can't tolerate that, right? We can't tolerate it while we're working, and we certainly can't tolerate it in retirement. So bonds up here, also relatively safe. Let's say that was a 5% annualized rate of return on average. At 2.5% inflation, your real rate of return is 2.5%. So with inflation, this is something that is really important thinking about long periods of time. And women in the aggregate, we live a long time. So we really have to be aware of are our investments keeping pace with inflation, and are they exceeding the rate of inflation? Cash and bonds are very risky in an inflationary environment. because the increase in price of goods and services is going up and your cash and bonds are not keeping pace. Bonds might, right? But cash probably won't. Stocks, with all their volatility and that part of the risk, stocks do tend to return about the rate of inflation plus 5 or 6% over long periods of time, right? Like stocks, because it's ownership in companies, stocks tend to adjust for inflation way better than bonds or cash do. So you have to take that into account too. That's an excellent question.
Okay, awesome. And then another question is actually about real estate versus the stock market. So Isabel said, well, she asked, would you say investments give better returns than investing in real estate? Her example is another home.
Yeah, I don't know. I would say it depends on the home, right? I start from this, and this is just like, I have lots of real estate investing clients. There's lots of real estate investors in Osmond's investing group. We talk about real estate a lot. I think that a really well-run investment property can probably return, probably have returns comparable to the stock market over the long run. With stocks, you basically like invest in stocks and then you just let stocks do their thing and you try not to sell during crashes, and you should end up with this 8, 9, 10% return over time. With real estate, there's a lot of other components coming in here, right? There's how many months of vacancy do you have? Are you increasing the rent over time to compensate for the fact that your property wears out? You have to replace things. You have to replace the roof and the AC, and there's all of these other components with it. So kind of going back to the slide before, I think for people who are really good at managing properties, they can probably get rates of return comparable to something like the stock market, maybe with less risk. But for kind of, I had a rental property for 5 years in Austin, and it was fine. But one of the things that I didn't love about it was, I kind of bought into this idea that it was passive income, and it wasn't passive, it was active. Like, I had to deal with tenants, I had to replace a roof, I had to answer the phone when people needed their toilets to get unclogged, right? There's a lot of activity that I needed to put into this house that also wasn't accounted for in the rates of return. So I would say, like, when it comes to like real estate and the stock market, like, you have to, like, it's like pick your poison, right? Like, which would you rather do? Some people would rather have a house that they can go touch and they understand how it works, right? Like, it's very intuitive how to invest in real estate. But what if you overpay for your house? Or what if there's some sort of man-made natural disaster like we had last week, and all of a sudden you have a $10,000 plumbing bill, right? Like, those are the risks inherent in that. Whereas in the stock market, like, we all know that the stock market is going to go up and down. But the expectation is that if you hang in there, it'll increase at some relatively high rate over the long term. So that was probably kind of a non-answer, but I think it depends on the person. It depends on the investor.
So another question that came in is, when we're looking at this chart on this slide, how should we think about taxes in like the big picture of this?
Yeah, that's a good question. This chart doesn't address taxes at all. One of the good pieces of advice that I read I guess it's been more than several years ago, is try not to let taxes be the tail that wags the dog. With investing, like, the two main taxes that you end up paying is taxes on income, right? So you pay tax on dividends received, you pay tax on rental income, you pay tax on interest, if those things are held outside of a retirement account. You also pay capital gains tax, right? So on the difference between what you buy something for and what you sell it for. Again, if it's not held in a retirement account, or if it's not your homestead. Tax planning taxes and tax planning are an additional cost that you'll just have. It's nearly impossible to be perfectly tax efficient. With investing, kind of the the main tips around tax planning are that for most people, there's a big difference between short-term capital gains. So do you own an asset for more than a year before you sell it? If you own that asset for less than a year, you pay taxes at your ordinary income tax rate, which is like your tax bracket. It's like getting another paycheck. If you own assets for more than a year, then you pay at least what is now a more favorable rate. Most people pay 15% long-term capital gains tax. So understanding the tax system can help you mitigate some of these issues. Like if you've owned a stock for 300 days, you probably want to wait another 66 days before you sell it so that you convert your gain from short-term gain to long-term gains. So knowing the tax code is good. Certainly, like, taxes can add up, especially if you have a lot of short-term transactions. Putting a lot of effort into generating income or gains that are then taxed at a relatively high rate. Hopefully that helped. Should I keep going?
Let's keep going.
Cool. Okay, so your different assets play different roles in your portfolio. So I think of a portfolio. Your portfolio is like an umbrella over everything you own. Like in your portfolio, you might have a 401k that you have at work, and in that 401k, you have a bunch of stocks. And you might have an account at Coinbase where you fiddle with Bitcoin, and you might have your home that you bought that you invested in, and you might have a cash account and a savings account. Everything under an umbrella, all of the assets that you own are part of your portfolio. So, most people don't just have one thing or the other. They have a mix of things. And different assets have different roles in your portfolio. So here we just have like the two basic asset classes that we've kind of talked about, stocks and bonds. Stocks are this green line. If you can see this dark green line, this is a chart showing the price of the Vanguard Total Stock Market Index Fund from the beginning of 2007 until yesterday. So we can see with the green line, the stock market, it's down sharply in the financial crisis, 2008, 2009, and then it's kind of going up and down, but generally trending upward for a relatively long period of time. Then we have in the end of 2008, we had another pretty sharp, fast decline, 20% at the end of 2018, which was nothing compared to the decline in March of 2020, where the stock market fell basically 34% in 3 weeks, right? But even through all that volatility, if you had started investing at the beginning of 2007, made it through 2 legitimate crises, plus some mini crises along the way, your investment would be up almost 186%. Then compare that to your investment in bonds, which is bonds are like loaning someone money. It's a lending relationship. I'm going to lend you money, you're going to pay me back plus interest, right? They're more stable, but lower growth, right? Like I said in the previous slides. So if you'd have played it safe that whole time in bonds, you'd be this blue line, right? Or see how stable it is? Still moving up and down a little bit, right? But pretty stable. And in exchange for that stability, the increase in price over that period of time would be 20% versus the 185. So, part of kind of going back to how do you choose which line you're on or which line you're closer to is, again, it's a function of, well, how much volatility can you tolerate? Do these bumps make you excited or do they make you feel sick? And part of it comes down to like, well, how much growth do you need? Most people don't start out with enough money to be able to have the luxury of playing it safe, right? Most of us need to create wealth and generate wealth over time. It's not given to us, right? We're not starting with $5 million. We're trying to get to $5 million, right? So you kind of have to balance those things. But stocks and maybe investment properties, stocks and investment properties play the role of growth. Bonds and cash play the role of stability. and safety. So you kind of have to figure out, okay, like which line do you need to be closer to in order to get where you want to go. Before we do this, I'm going to take we have time for some questions, but I'm also going to pull up an Excel spreadsheet and walk you guys. I'm going to kind of go on this, go down this path a little bit farther, since this is investing for beginners, on kind of what I mean by, you know, how do you choose the assets? What growth rate do you need? What growth rate do you want? And kind of what are the choices you might make in real life? So certainly, Gwen, if there's a question, you can go ahead and pull it up while I try to figure out how to pull up my spreadsheet. But if there's a question, feel free to shout it out.
Yeah, we do have a discussion going on in the chat box about like minimum time frames for money that we want to put in the market. And any thoughts that you have on that. Your exercise might actually cover that too.
Yeah. I wasn't planning on it, but that's a really good question. What is everybody else saying?
So let me scroll up to the first question. Okay, so Clara's asking, it looks like she has some money in cash because she's hoping to buy a place, but probably not for 6 to 9 months. In the meantime, would you suggest investing in stocks and then taking it out when she needs it? Would there be taxes on those profits? And folks are kind of saying generally that 6 to 9 months maybe isn't quite enough time.
Yeah.
I'm seeing a suggestion of a short-term CD and wondering if you have any thoughts.
Yeah, that's a great question. I'm going to give that a hard no on the stock market. I think of long-term investing as 10 years plus. I'm just going to go back to this chart here before I go off this chart. So if we go back to 2007 here, can you see my arrow when I'm moving it around, Gwen? Can you see my arrow?
We see it. It's a little light against like the white background, but.
Okay. So over here, I'm going to move it wildly. Over here, 2007, stock market's doing fine. Then financial crisis hits, right? It took not 6 months, not 9 months. It took 5.5 years for stocks to get back to where they were, right? So that's like, I come back to a 5-year time horizon for stocks for that reason, that when things go bad, they can go bad for a really long time. This last year, not the same situation, right? Like market fell really fast, bounced back really fast. That is not the norm for the stock market. So that's an excellent, excellent question, because I think it brings up like a couple points. Like if you're new to investing, yes, lots of volatility, but most of the time, the stock market does not bounce back like this with this crazy V-shaped recovery. Most of the time, it looks like a check mark, falls fast, and then goes up slowly. So you can easily get caught in a 6 to 9 year time horizon where stocks are down. And now you have 20% less of a down payment than you thought you were going to, and you're putting off your home buying dreams, and it's not good, right? One of my favorite sayings in the stock market is bear markets take the elevator, bull markets take the stairs. So it means that when prices fall, they fall fast. And when prices recover, they tend to recover slowly. Again, this is not the case from 2020. It was completely unexpected for the market to recover as fast as it did. And it's not the norm. It's an outlier. The whole year has been an outlier with how fast it fell and how fast it recovered. If we go back throughout history, most of the time, bear market takes the elevator and you're down 20, 30, 40%. And it takes many, many months, if not years, to recover. So for you people like saving up money for down payments on houses or keeping money safe for some reason, a renovation, that sad 0% cash is really the only option. Maybe you can get a 6-month CD that pays you like 0.2%. It's not super helpful, but it's just the way it is, right? Otherwise, you are taking an extraordinary amount of risk. If you got gains, they would be taxable at short-term rate, so you'd get to keep probably 70% of your gains. But if the market falls, you could easily be at a 5%, 10%, 15% decline in the stock market over that period of time. I mean, the NASDAQ fell by something like 5% this week, right? During COVID, the S&P 500 fell by 12% in a day. In 1987, the S&P 500 fell by 20% in a day, right? So that's, it's always in the back of my mind, right? Like, okay, this can go wrong very quickly. That comes back to the time horizon. Do I have time to let this sit here? I'll just wait for it. I'll just wait for it to take the stairs up towards this 185% increase. I don't need it right this very second. Really, really good question. I'm going to pivot just a little bit and run through an exercise with you all. I don't know if those of you who have seen me speak before notice that I don't have my compounding slides. We'll do something that's related to it though. And so I'm just going to pull up this. Can you see my Excel spreadsheet, Gwen?
Yes, and I just want to say that Caitlin looked especially disappointed.
I know some of you have seen those slides.
Melissa noticed too.
Probably 20 times, right? So I'm giving you a break and we're gonna do something a little bit different, right? So this, I hope, especially for the beginners here, will help solidify some of these concepts, right? So this is what I do in classes and this is what I do with clients as part of like a strategic planning exercise. So usually I have these slides that talk about the concept of compounding and time value of money, which is like what you learn in Finance 101. And it's the math it's the underpinning of the whole financial system. So to cut to like the crib notes version of time value of money, the idea is that there are 5 inputs to time value of money. You come up with assumptions for 4 of them, and then you solve for the 5th one. And this is how your mortgage amortization schedule is calculated and your student loan payments and how you forecast how much money you could have at retirement. But I wonder if maybe, Caitlin, since I see you right there, Caitlin, would you be willing to help, like to be my faux client in this exercise to help me come up with inputs for these?
Yes. The funny thing is I just opened my own blank spreadsheet so I could do it along with you as myself. So,
oh, awesome.
Yeah.
Well, then I won't ask you.
Free advice.
Maybe you could chime in. Okay. So let's start here. So like with time value of money, the first input is present value. So this is what something is worth today. So if you add up all of the things that you own or all of your retirement accounts, you'll be able to see what your present value is. So we can start with any number. Caitlin, do you have a number you want to start with? Oh, you're muted.
In this world.
Hold on, start again.
Present value is everything I could sell, like a house, what I would get if I sold the house, plus the number that's in my retirement account right now.
I'm going to narrow it down a little bit there. I'm going to say like all of the money in retirement accounts.
Okay.
And set aside the house or the home that let's just deal with retirement accounts for now and set real estate aside.
Do you want me to be the number it should be for my age, or
I just pick a number, any number. It can be.
Let's just say $200,000 in retirement accounts.
Okay. So Caitlin has $200,000 in retirement accounts. So that's her present value. We just added up the value of her accounts and came up with $200,000. The next input in time value of money is number of periods, or in this case, number of years. Most of the time when we're talking about retirement planning, things like that, we're talking about years. So Caitlin, this is the number of years until you start taking money out of this account.
Okay.
So it's related to like this retirement question, right? Like when are you going to retire? Generally it's like, okay, I'm going to work for a certain number of years and then I'm going to stop working and then I'm going to start pulling money out of these accounts in order to replace my income, I know that retirement can be there. You're going to let this money grow before we start taking it out.
Okay. I'm 45 now, so let's just say I'm very traditional and go to 65, so 20 years.
Okay. All right. All right, so we have 20 years to grow this money. The next input in our time value of money calculation is payment. So while we're saving for retirement, this is the amount that you can afford to put into these accounts every year for the next 20 years.
So every year.
Yeah, so it's based on your income, it's based on your expenses, how much money is left over every year.
Let's say 7,000.
Great. All right, so $7,000 is going to go into this account every year. All right, the next input is our rate of return calculation. So we just looked at that slide showing what over the last 25 years, what rates of return have been, and we can use that information to figure out what we think expected rates of return will be like in the future. So I usually do it like this. All right, I expect cash over the next 20 years to be something like 0 to 2% per year. I expect bonds, a little bit riskier. You're taking the risk that people don't pay you back, but we're in a low interest rate environment. It's going to be a struggle. Maybe over the next 20 years, bonds return 2 to 4% per year. Oh, no, I didn't like that. 2 to 4%. And then stocks, let's say we think over the next 20 years, maybe they return 8 to 10% per year. So we're kind of giving ourselves a range. So based on your time horizon, based on your risk tolerance, how would you split up your investments in cash, bonds, and stocks in your retirement account?
Well, it's interesting because the Vanguard Target Retirement 2040, which I think I qualify for, has like a 20% bond, 80% stock. Mm-hmm. But I like to follow Warren Buffett's advice for his wife, which is 10% bonds and 90% stocks. And I need to grow a lot more money than Warren Buffett's wife. So that's my target.
All right. That's super helpful that you explained it like that, right? Because that means, okay, for our calculation over here, you're taking a risk, you're mindfully taking this risk, you're going for it. Most of your money is in stocks. So we can say, okay, I think a pretty good estimate for your target or expected rate of return is probably 8% per year. That might be a little low, but it might be a little high. We don't know for sure what it's going to be, but I think that's a pretty good guess. So now we have enough information. These are our 4 inputs, and now we can solve for the 5th, which is future value. So in Excel, we have these functions. There's all sorts of calculator functions, right? But there's a whole set of financial functions. So here we can solve for future value. Okay. And Excel will do this calculation for us. I didn't write this in a slide, but know that compounding and time value of money deals with exponential growth. So in the formulas, there is an exponent in there that ends up being very important. So here our expected rate of return is 8%. Our number of periods, we're going to grow this money for 20 years. Caitlin's going to put $7,000 a year into her accounts, and she's starting with $200,000. So now we have enough information to solve for future value. So according to time value of money, if all of these things hold true, that she has $200,000, that she grows it for 20 years, that she adds $7,000 per year, and she gets an average of 8% per year in the stock market, that by the time she's 65, she should end up with $1.25 million.
Which is not enough.
Well, then we ask the question, well, is it enough? And we can use the same concept run in reverse to see, well, how much could a retired person theoretically afford to take out of these accounts over their lifetime? So we use the same 5 building blocks, just in a slightly different way. So you're 65 now, and the present value of your accounts is $1.2 million. Let's do future value. I'm going to say sorry to Saralina and say that we're not worried about you leaving any money behind.
She is on her own.
She's on her own. We're going to assume that you run this account all the way down to 0 and you bounce the last check you ever write and you peace out, right? Okay, so future value is 0. The next input is number of years. So in this here, you're 65. Usually when I'm running this, I assume that people live to age 95, unless there's a reason to say it'll be more or a reason to say less.
My grandmother lived to 102.
Okay, so I'm gonna put 100 in there.
Lived to 110.
All right. So that would be a good reason to put 100 in there instead of 95. So we're trying to make this money last for 35 years. So that's our number of years. Our next input is rate of return. So when you're in retirement, this is just my experience watching people do this. When you're in retirement, you don't necessarily want as much of your money in the stock market, right? Because we just talked about that, like, oh my gosh, like the market's up, it's down. When you're taking money out of the market, most people get much more conservative and they have more money in cash and more money in bonds because they're gonna need that money, right? Like in the next 1 year, 2 years, 5 years. And so they'll need enough money set aside to pay the bills while they wait for stocks to recover when stocks inevitably go down and then back up. So I usually start with a nominal rate of return in retirement of 5%, like a 50-50 portfolio over a 35-year time horizon. Do you guys see kind of where I get that? I'm just basically saying, okay, 50% at 2% and 50% at 8%, that gets us to 5% per year. But here, going back to that question that was asked before about inflation, when we're in retirement, we need to be really careful about inflation, right? We're pulling money out of the account. If we don't adjust for inflation, the amount of money that we're pulling out is going to go less and less far every year, right? And over 35 years, that can get really rough really fast. So we want to adjust this for inflation. So I'm going to go back to my 2.5% inflation estimate for these 35 years. So that gets us a real rate of return of 2.5%. So every year, your wealth will be increasing by 2.5%, but you'll be taking money out of the account. Does that kind of make sense to people? It's a way that we adjust for inflation. So now, instead of calculating future value, now we can calculate payment. Remember, we haven't dealt with payment yet. So this is now what we're solving for. So we use our financial calculator, payment, okay. We're gonna get a 2.5% real, we're expecting a 2.5% real rate of return above inflation for 35 years. We're starting with 1.25 million and we're ending at 0. So now according to time value of money, you could afford to take out $54,000 per year for 35 years and adjust that amount by 2.5% each year to account for inflation. So now when you see that, like this is like the financial planning part of it. You look at it, you're like, okay, is that enough? Right? Like it might be if you have a paid for house and Social Security and you kind of layer all those things on, or if you have a pension as well, you might look at that and be like, all right, like we can make that happen, right? If not, we come up here and we start adjusting our inputs to figure out what do we need to change. Oh, sorry, shoot. No, don't go away. Wrong one. What do we need to change in order to make the math work? So the choices, and this is for everyone, right? With all planning, the choices are work longer, save more. It's tough to adjust to this rate of return number that much higher, right? Like we're already, I mean, 8% is a conservative estimate for the stock market over 20 years, but it's definitely in the range of possibilities. We can't put a 15% number in there and assume that we're Warren Buffett, right? It's just not reasonable to do that. We maybe could put 10% in there and just like fingers crossed. I will say that if you consider yourself to be conservative, and maybe if, you know, Caitlin had picked something else and she said, listen, like I'm pretty conservative, I'd like to be 50-50, and so I'm expecting a 5% rate of return in my portfolio. Then do you see how the numbers all adjusted downward? She went from 1.25 to 762,000, and that went all the way down to, okay, a $33,000 withdrawal in retirement. If you saw that and you were like, that $33,000 is not enough,
No.
then, you know, if we had started there, I would come back with, okay, what would you rather do? Would you rather work longer? Would you rather save more money, which means spending less money today? Or would you rather take more risk and assume and expect that you'd get a higher rate of return, but with much more volatility? Like, which would you rather do? Or some combination of those things. So like you're really thinking there's really, you know, we have what we have right now. So our present value is known. So we really only have 3 levers to pull when we're doing these calculations. How long, how much risk are we taking, and how much return are we expecting, and how much can we save?
Okay, I'll try for 10,000 a year.
Okay.
But yeah, I want my rate back.
Yeah.
Back.
We're going back to the original.
Okay.
We're going for it, and we're saving 10,000 a year. Okay. So that kicked it up to almost 1.4 million.
And I can have 60,000 a year.
Yeah. So it went from 54,000 a year to 60,000 a year. That's a big difference on a percentage basis. And so this is how we use these pieces to think about investing, right? Instead of it being like in a vacuum, like, oh my gosh, I'm either in the stock market and it's going up and down wildly and I don't know why I'm doing this. It's like, when we start putting into context of our own financial planning and our own resources, then you can make a mindful choice, right? Like most people don't choose to be exposed to the volatility of the stock market unless they have to, right? Like most people aren't adrenaline junkies. There are adrenaline junkies who just love it, right? And they're just in it, you know, they just want growth at all costs. But most people will only take as much risk as they need to in order to get what they want. And that's like what that's what this whole exercise is for. So I'm going to stop there. I just wanted to run through this with all of you so you can see, like, when we're talking about the expected rates of return, how you can, again, like how you can connect it back to what you're trying to do. If you have a lower rate of return in there, maybe this is the right choice, that you're a more conservative investor, but a more aggressive saver, right? You can save $35,000 a year and kind of, maybe it's 30 instead of 10, and basically get to the same end point. That is a perfectly reasonable choice if you can save $30,000 a year. So this is how the trade-offs work with time, with expected rate of return, and with your savings rate. Are there any questions on that? There are questions, but what questions are there? Yeah.
Okay, we do have some questions. The function code for future value is -FV. Okay.
Yeah, that box will come up and walk you through the inputs. I'm also happy to share like the ugly Excel spreadsheet that we just built. I think I have one that's a little nicer looking that I can share with the group too. Where like it's basically like walking you through a scenario analysis where you can solve for any of these inputs, right? Because it looks like, okay, how much money do I need now in order to get to where I want to go? How many years is a big one? How many years until I get to $1.5 million? Or how many years until I get to whatever the end result is? How much do I need to save in order to get to where I want to go? What rate of return do I need in order to get to where I want to go? And then, okay, then the future value one that we just did. So they're all very useful pieces of information that you can use in order to make like the day-to-day short-term decisions in your life.
So Jeannie's asking about factoring Social Security benefits into retirement planning. Is that something that we should or should not count on?
I say yes. Social Security will exist in some form or fashion for everyone on this call. If you are closer to retirement age, there's a less of a chance that they're going to fiddle with it. If you're farther away from retirement age, there's a greater chance they're going to fiddle with it. They're going to have to. Social Security does this same calculation to figure out how much they can afford to pay and at what period of time, at what time, right? So in order to change like Gwen, is probably not going to have a full retirement age of 67. Sorry, Gwen, right? You're full because you're in your early 20s. They're going to adjust that. They're going to say, listen, we're giving you enough time. You're not going to be able to draw Social Security benefits until you're 72. So just deal with it now. You have plenty of time to adjust, right? If you're 60 and haven't started drawing Social Security benefits, they're not going to change it on you. First of all, it'd be political suicide. Second of all, it would be really uncool. And it wouldn't even really help things that much, right? Those of us in the middle, maybe, I'm almost 42, maybe my retirement age gets pushed from 67 to 68 or 69, right? But you have to give people enough time to plan for it. So all that to say, I do think Social Security gets layered on here, right? You take the amount that you can take out of your voluntary 401ks, IRAs, these voluntary savings accounts, and then you add in Social Security. You can get estimates at the Social Security website. There's a Social Security estimator that's up there. You just plug in your Social Security number. It looks at your earnings history and your age and will give you projections on what they think your benefits will be. If you have a pension, if you're a teacher or you work for the state or whatever, you work for the federal government, same thing with pension. You can go to the teacher retirement system website and calculate what your pension would be at age 65. And so that you would get a pretty good idea of, okay, Social Security comes online at this point, pension comes online at this point, and then to supplement those two guaranteed streams of income, we're going to take more or take some out of our IRAs or 401ks or brokerage accounts or whatever we have set aside. So I do think you should take Social Security into account. Some people don't want to. That's fine. It's going to make the numbers harder, but it's your calculation. So it's so just kind of do what you think is prudent. Great question. Thank you, Caitlin, for being the guinea pig on the financial planning crash course.
So this actually came up with Caitlin's example, but I'm waiting on clarification from someone who asked a question. The question is present value retirement accounts only, wait, hold on, here we go. Is present value retirement accounts only and not future value of residential real estate?
So when I do these calculations, because I don't know what numbers to put in here, I think of it on an income basis, right? So for your homestead, for example, really the way I prefer to think about it is that, okay, in Caitlin's case, let's say that this is $65,000 she would take out of her retirement accounts, plus she would get Social Security, plus she would have a paid for house because she'd pay down the mortgage over those 20 years. And so then it becomes okay, is the $65,000 plus the Social Security enough to cover the bills you're going to have when you don't also have a principal and interest payment on your mortgage? That's how I adjust for it, instead of having the present value be, instead of having this be cash, your homestead, your residential real estate, kind of all of those things. Usually people who invest in real estate as an investment can tell me what their expected rental income is. So it would be, okay, $65,000 out of your retirement accounts, Social Security, paid for home, and rental income of some amount. And if you're a real estate investor, you're probably able to give me that amount, right? I think that in 20 years, the mortgages on my rentals will be paid off and I'll be able to draw $36,000 a year out of my paid off rental homes. So this is like, you know, I don't try to overly complicate it, because here, like at least with my clients and my area of expertise, I'm not advising people on investment properties, like on rental properties. I'm mostly advising people on the mix of investments in their like retirement accounts and brokerage accounts. So I need to know kind of what this breakdown is versus like layering in all of those other pieces that I am taking much more of a guess at. So I don't know if that answered that question. This is definitely like a spreadsheet that's specific to me and the way that I think about planning and the way that my clients think about planning.
Okay, awesome. Kristen said that makes sense. All right, another question. So for the payment that we'll be able to pull out each year after retirement, how much is that money taxed?
It depends on what account the 200,000 is in or the 1.5 million is in. Money that comes out of pre-tax retirement accounts, so anything that's not a Roth IRA, whatever portion of that 65 comes out of a 401k or traditional IRA or rollover IRA or SEPA IRA, that part will be taxed as income. So if you take out $65,000 from a 401k, it's taxed like $65,000 of income. If you take some or all of it out of a Roth IRA or a Roth 401k, then none of that $65,000 is taxed. It comes out tax-free. If some or a portion of it comes out of a taxable brokerage account, just like an individual account or a joint account in your name that has been invested this whole time, then you'll pay taxes on the capital gains, right? So the amount, the difference between what you bought it for and what you sold it for. Your broker keeps track of that. So you should have pretty good clarity when taking money out of all of these accounts in retirement, what your tax rate is going to be. Most of the time, people kind of have all three of these sources in some form or fashion. So every year you can figure out, okay, how much am I going to take out of my 401k? I'm going to pay taxes on that money as income. Then I'm going to supplement that with some tax-free money from my Roth. And then I'm going to sell something from my brokerage account and pay 15% in long-term capital gains on that chunk. And you can really get into like some heavy-duty tax planning at this point. And so like you have a lot of flexibility in retirement. Where does the money come from? That flexibility does run out a little bit in traditional non-Roth retirement accounts. Once you hit age, now it's 72. Once you hit age 72, they make you start taking money out of those accounts in the form of a required minimum distribution. So they'll say, listen, you haven't paid taxes on this money yet. You set this all aside tax deferred when you were working. Now the money has to come out and you have to pay income taxes on it. But that's really like, once you're kind of in your 60s or 70s, you either start figuring out what your tax outlook might be, or you start looping in an expert to help you figure that out. Again, like with this super simple spreadsheet, I'm just trying to get people to investing decisions with this spreadsheet. This payment is a gross payment, right? And then everybody's job would be to make this as tax efficient once this money starts actually coming out. Really good questions. Cool. All right, I'm gonna go back to the slides. I know it's already 4, so maybe I'll just try to maybe go through the rest of the slides relatively quickly so that we have some time for a Q&A towards the end. Does that make sense to everybody? All right, stop share. I see. Okay. I'm going to go through this relatively quickly. We did intro to the stock market last month, and so there is a video on the AWIG YouTube channel with that if you really want to kind of learn more about the stock market. Long story short, stock is ownership in companies, right? So we are buying shares of companies, and we're hoping that they create goods and services that people want to buy in the future. The S&P 500 index is a commonly used proxy for the stock market. So when we're talking about stocks, we often kind of shorthand that and say, S&P 500 was down 2% last week. S&P 500 was up 50 points today. S&P 500 is a list of 500 large, well-known US companies. Standard & Poor's, the company who puts the list together, they take the stock price of all of the companies in the S&P 500, they put it through their special proprietary formula, and it spits out a number. The S&P 500 closed at 2843 today. So just S&P 500 stocks, large US companies. There are other indexes that chop up the universe of stocks into different subcategories. The NASDAQ is tech heavy. The Russell 2000 is small companies, small cap companies. The Dow Jones Industrial Average is 30 very large, well-known US companies. So each of these indexes is talking about a different subset of the stock market. But whenever we're talking about stocks, we're talking about ownership in a company. That part is very important. It's not lending money to a company. When you're the owner of a company, you only make money if the company makes money. So that part is very important. Most people invest in stocks via mutual funds or exchange traded funds. Both mutual funds and exchange traded funds, or you can think of them like a basket. And inside the basket, there are a bunch of different stocks or bonds, right? But a bunch of different stocks. Instead of you owning all of the different stocks, you own a piece of the basket. So it makes it really easy for regular people to have, you don't just have to pick one stock. You can pick a whole basket of stocks, right? And it gives you a little bit more safety, a little bit more. You're still in the stock market, still very volatile, but a little bit more safety because you're not just picking one stock. If you pick one stock and that one stock is just the wrong pick, you're taking on additional risk. So most people invest in the stock market in stock mutual funds or stock exchange traded funds. Another word for it is equities too, if you've heard of that word. I'm gonna kind of zoom through this part because we went through it in the just last month. There is a relationship between, I'm gonna go back a little bit. The only thing, maybe not the only thing, the biggest thing in the stock market is this concept called earnings. Earnings is what is left over after a company pays all of its other costs. Earnings are what owners have a claim on. So if you're an owner of a company, you want that company to be able to generate a lot of earnings, or a lot of profits is another way to say it. Companies don't always have positive profits. Sometimes there's negative profits or negative earnings, but you wouldn't want to own a company that did not have any chance of ever making profits in the future. There just would be no point. The reason you're an owner of a company is because you want that company to pay you some money, and the only money it can pay you is what's left over after everybody else gets paid. So there's this really tight correlation between earnings and profits, or how much money a company can generate, and stock price. So this chart here is my very favorite stock chart. And again, I know that some of y'all saw this last month, but some of you didn't. This red line, these are the profits or the earnings that S&P 500 companies actually earned going back to 1988. So that's the red line. We can see that sometimes profits are up, sometimes they're down, but they generally are trending upward as our economy expands. The black line is the price of the S&P 500. So the price of those 500 companies. Most of the time, there's this really tight correlation between earnings and price. When the stock market fluctuates, it's almost always because we don't know what exactly future profits are going to look like. If we think future profits are going to be higher, then we expect the price of the stock market to go up. If we think future earnings are going to be low, then we would expect the price of the stock market to come down. So this forward-lookingness of the stock market always trips people up, because people say, like, how can the stock market be up if the economy is so bad? And the answer is, stock market is looking forward into the future. Stock market does not care what is happening right now. Stock market is always forward-looking. So that is why you can see this black line, the price of the stock market reacted way before earnings and profits started coming in. The black line, the price of the stock market, is just assuming that companies are going to be more profitable in 2021 than they were in 2020, and assumes that companies will be more profitable in 2022 than they were in 2021. So now, like, hopefully you can kind of see the risk here too, right? Because what if the stock market's not right? What if those profits aren't as high as they're being estimated right now? I mean, and the answer is the price of the stock market will fall. In the short term, this is incredibly difficult to measure. It's incredibly difficult to gauge. It's incredibly difficult to predict. And so what I will offer to stock market people who want to be in the stock market is stretch that time horizon way out. Stretch it out 5 years, stretch it out 10 years, stretch it out 20 years. Because can we assume that stocks will be more profitable 10 years in the future than they are today? Like, yeah, that's a pretty good assumption. It's not a guarantee, but it's a pretty decent assumption. So if you're investing for 10 years, that makes it easier to be in the stock market today. You are definitely going to have to accept that that black line is going to go up and down in the short term on our way to the long term, right? Much easier than trying to figure out what the market will do in 2021, what the market will do in 2022. Should I get in? Should I get out? Should I jump in? Should I jump out? So difficult, you guys. It is so difficult. So if you don't have to do it, you can just say, well, today's price might be high. It might be fair. It might be low, whatever it is, we don't know, because we don't know exactly what the future will look like. But if you're investing for decades, then it makes it easier to get in at today's prices, right? Because remember, like, we were at all-time highs back during the dot-com bubble. We were at all-time highs right before the financial crisis in 2007. And the market eventually recovered, if given enough time. If you have enough time to wait for the market to recover, you don't have to get stuck in this short-term trap. It's so difficult to project these things. It also maybe makes it a little bit easier to buy the dip when the dip happens, right? Like dips here, like look at all the dips, good buying opportunities. When the stock market falls, it doesn't have to be the end of the world, right? It can be an opportunity for you to invest more money at lower prices. Like even these like little dips, and even if the market ended up dipping more, again, given enough time, we expect the companies in the economy to figure out how to make money. They're incentivized to do so, right? We live in a capitalist economy. Our whole system is set up to incentivize companies to create goods and services that people want to buy in the future. And assuming that that continues, companies will figure it out. They'll figure out how to make money no matter what happens in the economy, no matter what the laws are, no matter what the regulations are, like no matter what interest rates are, they'll eventually figure it out, but it might take a little bit of time. That's what these business cycles are, right? Like you can see the earnings going up and down. They don't go up in a straight line. You know, we have recessions, we have growth, we have all sorts of things happening. But stretch out your time horizon if you're in the stock market. This is just a chart I like to show, showing all of the terrible things that have happened going back to 1957. That's another thing that trips people up is, well, what about at the beginning of the Trump administration? It was, well, what about Trump, right? And then it was, well, what about North Korea? Like, what about all of these things, right? Like, all bad things are going to keep happening. So if you're waiting for like the all clear signal in the stock market, you're never going to get it, ever, ever. There's always something to worry about. So it's just the way it is. Oh, this is just a slide from a couple months ago. People, you know, get concerned about the election cycle every time we have it. It really doesn't matter from the stock market's perspective who's in office. So just like, don't have that be part of your calculation. It's really, it's way more complicated than that. Here, investing in real estate, like for people, especially beginners, like this might be your first big investment, right? Maybe you have a 401k at work, but you know, investing in a home can be a really great starter investment, right? But it is relatively low risk, relatively low return. Like if you think about your home, oh my gosh, like in Austin, if y'all are in Austin, like you know that you go out and you try to find a home and you have to offer $50,000 above listing price to even get considered, right? So you're starting off paying high prices. It might take a while for you to be able to sell the house at a higher price, right? Maybe not. Maybe you could flip it next year for 15% more. But over time, your home doesn't tend to be a great investment because you spend money on your home, right? Like you have all these extra costs to nest. You're doing your landscaping and you're painting everything. You're getting cute furniture, right? Like all of those are costs of home ownership that are baked into that investment idea. That said, over the long run, having your home, locking in your mortgage payment, paying down that mortgage over time, a lot of people come out like financially stable, with owning homes. That said, I don't think you have to own a home to be a good investor. You just have to be able to save money and invest money. You don't have to own a home. We talked a little bit about residential property and commercial property, so we can talk about that in the Q&A if people have other questions, but we can kind of cover that. We talked a little bit about inflation. So here's like they measure inflation all the time. People are always measuring inflation. It's really unpredictable. It's really hard to figure out if inflation is going up, if it's going down, and what impact that has on the market. So this is just a chart showing like how crazy year over year inflation can be. And this is just going back to 2010. This is a different measure of inflation. In the recent past, so this just goes back to 2010, inflation has been pretty low. So this is a 1.5% R, compound annual growth rate. It's really been hard to get inflation above 1.5% on a consistent basis for a long period of time. Here's a little bit about taxes. I'll send these slides out so you guys can read these if you want to. I think I already mentioned that now you can wait until age 72 to take RMDs from your IRA. If you inherit an IRA, last year or this year, there are some different rules about distributing IRAs that you inherit. Now you have to do it over 10 years instead of over your lifetime. So that's a relatively big change to taxes. And then there's just some other little pieces here that might be applicable to you. All right. All right. Made it somehow through all the slides with 17 minutes to spare. So we can go back to any of the slides that I kind of bounced over, or you can read them when we send out the slide deck. But what questions have come in since I kind of went through those?
Okay, so there have been quite a few questions throughout the discussion that are just a little bit all over. Mm-hmm. Actually, since we just looked at that retirement slide, I'll ask a nitty-gritty question that came in earlier on. Someone asked the 401k and the 457. The information says you can invest in either plan to the maximum limit set by the IRS. Does that mean that you can invest 19.5K total per year or a total of 39K per year?
So if you are eligible to invest in a 457, so I'm assuming you work for the state or something like that, you can actually put 19.5 in both if you have that much to sock away. So yay for you. That's one of the rare exceptions to that 19.5 rule. Most people, if you are eligible to participate in a 401k in a private company, you can put 19,500 or 25,500 into your 401k, depending on if you're under 50 or over 50. But if you work for the state and you're also eligible to contribute to a 457, you can max out both. So that's awesome.
Okay. Thoughts on whether a stimulus package will have a strong positive effect on stock prices? And if so, do you have an approximate percentage in mind?
That's a really great question. Stock prices are already pretty high. So my gut feeling, my gut forecast, if that's a thing, is that in 2021, the stock market will probably basically go sideways with lots of bouncing up and down, because that growth already happened, right? Starting last year, people started looking forward to stimulus packages. And so the market prices have already adjusted for this expectation. So I think that this new stimulus package coming in will be good for the real economy. So that means like good for incomes, good for employment eventually, right? Good for kind of getting things moving again and getting the economy reopened. But it might not have as big of an impact on stock prices as people think, at least right away. It might, just because, remember that the stock market is already anticipated those changes, right? So if we come back to this chart, oh shoot, I have a window that's kind of in the way here. You see this black line up here, right? It's way higher than earnings. It looks a little bit like what happened back here, right? When earnings didn't get as high as prices. This was the dot-com bubble back in 2000, 2001. If this black line is getting like, it's pretty optimistic that this stimulus will lead to higher earnings by 2022, right? But it's like the stock market has already skipped over 2021 and is already looking to 2022. Profits like have a long way to catch up to the expectations for price. So I know this can be like, this is maybe the most confusing thing about the stock market, is like we're looking at this disconnect here and you're like, man, all right, usually these lines are kind of together. Now they're really far apart. If the stimulus works as planned and the Federal Reserve policies work as planned and businesses get going again and profits go up 2021 and up again in 2022, then the black line probably just kind of goes sideways at some point until we figure out what 2023 and 2024 might look like. So I know that was a long answer, but I'm not super optimistic that I think the stimulus will help people, and that's good, right? But I don't know if it will help the stock market a ton. If it does, maybe it's, I don't know, maybe it's 5 or 10% from here. If the stock market starts looking ahead to 2023. That's just my gut. Again, my gut forecast, whatever that means.
Okay, I'm gonna combine two questions that make sense together, and then I think after that folks can unmute themselves and ask out loud if that sounds good. Mm-hmm. Okay, so someone asked earlier, I've always heard it's not a good idea to buy high. Since the stock market is so high right now, should we follow that logic and wait to invest until there's a dip? And then Caitlin just asked, how does a normal person invest during a quick dip?
Yeah, I don't know how normal people do it, because sometimes it can happen really fast. Because the stock market, oh, I wish I had this chart, but I don't have it in the slide deck.
Is it the all-time highs one?
Yeah, the all-time highs one.
I put it in the chat. Okay, I'm gonna.
Oh, did you? Did you link to it?
Yeah, I'll relink to it so folks can take a look.
Can you pull it up? Can I stop my share and you pull it up?
Oh yeah, yeah.
I'm gonna stop my share. So you can share that, the all-time highs chart. I love this chart. That's such a great question. Most of the time, like more than 50% of the time, the stock market is at or near all-time highs. So that in and of itself, like probably isn't a good enough reason, right? And so here, okay, so Gwen's sharing this chart, and we show this sometimes, right? So what this is showing is, if you see the green and the blue color, that is when the stock market is within 5% of all-time highs, right? Oh, when I said it was more than 50%, it's not. 47% of the time, the stock market is within 5% of all-time highs, right? So what, 63% of the time, am I doing my math right? 63% of the time, the stock market is at or within 10% of all-time highs. A 10% decline in the stock market is kind of an event. It's a 5% decline is a non-event. 10% of decline has like a cute name. We call it a correction. A 20% decline is called a bear market, right? And then beyond that, we just call it a crash. Most of the time, the stock market is at or near all-time highs. So if you want to buy the dip, I would kind of set expectations accordingly. Like, when do you start buying? Do you wait for a 5% dip? I mean, we're almost there if we're not there already. If the NASDAQ is down, I think more than 10% over the last month, right? So set your buy orders accordingly. Write them down on a sticky note to remind you that you are a buyer at a 5% decline or a 10% decline. 15% decline, they don't happen that often. 20% declines don't happen that often, but they obviously do happen, right? We have like the red and the orange here. Going back to like my 4 themes for the market and my thoughts that the market goes sideways but up and down with a lot of volatility, is I think that that volatility is going to be sharp and swift. So kind of back to Caitlin's question, like, well, how do you buy the dips, right? If you put in some work into it, you can, at your broker, most places will let you set something called a limit order. You can say, okay, I want to buy the Vanguard Total Stock Market Index ETF, ticker symbol VTI. I just happened to look before this class, and it's at $200 a share. So I just have that price point in my head. So a 10% decline from that is 180, right? 20% or $20 decline is 10%. You could say, okay, I want to buy when that stock or when that ETF hits 180. You can set something called a limit order. You buy X number of shares of VTI for $180. And then you can put it in the queue. You can do something called good till canceled. That order will sit in your account until VTI falls to 180. And then when it does, it'll execute your order automatically. Now, if VTI never falls to 180 and it goes up to 240, you never bought, right? So you want to be a little bit careful about getting greedy. And I say this from experience. Like, I am often a greedy dip buyer, and I'll set my limit orders too aggressively, and then they bounce away from me. So, but it's possible to do it if you're a buy the dips person. I do think we'll get dips this year. So if you want to watch it and if you want to pay attention to it, I think you have to define for yourself how far it needs to fall for it to be worth it to you to invest. As a relatively aggressive investor, like, I'm interested on 5%, more interested at 10%, really interested at 20%, but it's hard to actually do it, right? Because the reason the market falls by 20% is because people are freaking out, right? So you have to set up some system to actually do it if you're waiting for lower prices. Because just like being in this group, I hear this all the time, right? I don't want to invest at highs. Well, okay, well, what price do you want to invest at? Then make it so that you do actually invest if it hits that price. Because again, the reason it's going to hit that price is because something bad is happening, right? And it's going to be scary. So you have to invest sometime, either at all-time highs or when the price goes down, or otherwise you just never get invested. So it's like, this is like developing your own system. And what the system is, I personally think, is less important than having a system, whatever your system is. So I'll just offer that to people who are trying to make that decision. Dollar cost averaging also works, which is like, okay, if you have $10,000 to invest, maybe you chop it into 5 chunks of $2,000, and you invest $2,000 on Monday, $2,000 on April 1st, $2,000 on May 1st, $2,000 on June 1st, $2,000 on July 1st, at whatever the price is, since we have no idea what it's going to be. So that's another way to just, like, you just got to get it in there at some point, right?
So at this point, folks can unmute themselves, but Sarah, can you talk a little bit about if somebody wanted to dollar cost average, what's the benefit of doing that?
Yeah, the benefit is that you might catch the dips, right? Like, if the market falls, you'll buy more shares at a lower price. So your $2,000, in my example, your $2,000 on Monday, you know, maybe it buys 100 shares of VTI, 10 shares of VTI. If the price of VTI falls to 180, like in our example, then your $2,000 would buy 11 shares, right? So you would buy more shares at a lower price. So again, it's like a systematic way to buy in. Now, certainly, like if the market goes up and you invest your $2,000 at $210 per share, then you only buy 9 shares. But dollar cost averaging, and you can look and like Google it, there's all of these studies about dollar cost averaging. It's a really good strategy for normal investors. And it's what you're doing in a 401k if you're participating in a work, like a payroll deducted plan, right? A 401k or a 403b or a simple IRA through work. You are dollar cost averaging, right? Because you're putting a part of your paycheck in every pay period and it just gets invested. That's dollar cost averaging. But it's also a helpful way to turn, like if you have a big chunk of money you're trying to invest, a lot of people shy away from making one big high stakes decision. Like, oh my gosh, I inherited $100,000. What do I do with it, right? Like, do you just put $100,000 into the market on Monday? And most people behaviorally don't like that, right? Because then what if the market falls on Tuesday? You're gonna feel really sad. Behaviorally, I think it feels better to chop it up and do it in stages too. You might be better off financially. You might not be better off financially in the short term, but if you're in the market for long enough, you are definitely better off in the long term actually investing the money instead of not investing it. So it's like there's with every investor, like we're balancing financial questions with behavioral questions. And again, like that's why it can be so difficult. It feels like there's a right answer, but the right answer is the one that works for you, right? That's the right answer. And that's just, again, like I talk to so many people who get stuck on so many parts of investing that I do think, again, like any system is a good system, you know, as long as it gets you invested in something instead of just sitting in cash for months and years, decades, right? Never pulling the trigger on it. That's a great question. I'll just say I know that we're at 4:30, so for people who need to jump off, thank you everyone for joining. Thank you for the great questions and for all the chats in the chat box. I will stick around until 4:45, and then I'm probably going to have to go as well. But I'm happy to stick around and offer whatever I can or facilitate any discussions I can for the next 17, 18 minutes. Yeah, Jeannie, is that you? I think I see you waving your hand.
I'm
Hi.
muted.
Oh, I can hear you now.
Okay. Okay. So here's a real life example. I bought 16 shares of Home Depot back in 1998, maybe ish. Now, you know, Home Depot is a really good stock this year. So one thing my mother told me, and she's an investor, she has more money in the stock market than I do. She said, always get your principal. One thing you want to do is get the principal out of the stock you purchased. So I would think, as I recall, those 16 shares cost maybe $40 each back in 1998. So what are your thoughts on that, Sarah, about getting your principal out of your stock investments? Do you do that?
Yeah, sure. Again, like any strategy is better than no strategy, right? And so that is one that often people use. It's like taking your initial investment off the table. So that is one that people talk about. So like, yes, I mean, so that's a good strategy. One of the other things though, like kind of piggybacking on that with the sell question, I was just having this conversation this past week. I do think that when you sell something, it makes a lot of sense to have in mind what you're going to buy with the proceeds, right? Because a lot of times people will kind of get into this like, okay, I'm supposed to buy low, sell high, right? So in your case, like, okay, well, I bought low in 1998. Now I'm going to sell high. Let's say you just like cashed out all 16 shares. And then you've just moved money from stocks to cash, right? Like, did you intend to have that sit in cash forever? Or are you planning on getting back into something else? Like, what is it, right? Where it's like a two-step process instead of a one-step process.
I think Home Depot actually pays a dividend, so I don't really want to sell any of those shares, but
yeah.
You know, I do need to free up cash to buy other stocks. And here's another question. I have a couple of stocks that basically just fell to zero. For example, the first stock I bought was Dean Foods, and I think I had maybe 2 shares, and it was high at one time when milk was popular, but real milk is no longer bankrupt, and the share it's worth Dean Foods is now worth pennies on the dollar. I mean, I think I had 2 shares that were worth 100, and now they're worth just $5.
Yeah.
Hey, what do you? It's embarrassing. Is that just kind of, do those kinds of losses just happen?
Totally.
Okay.
Yeah, I mean, whenever you're picking individual stocks, like that's the risk, right? Is that whatever the stock that you're picking just doesn't do well, right? Certainly, it's like when you're picking individual stocks, you know, again, it cuts both ways. Like, okay, you might pick the next Apple, or you might pick the next Dean Foods, right? You know, but I think like for any investor who has a portfolio of stocks, like you don't want just one stock, you want a basket of stocks. Or like a bunch of stocks, right? So that if one is Dean Foods, it doesn't blow up your whole portfolio. And also expect to lose on some of your investments. Like nobody's perfect, right? You know, like the point is for the portfolio to grow in the aggregate. That doesn't mean that 100% of your ideas have to work out. Just like a relatively high proportion need to work out, but a lot of people end up with dogs. It's okay. If it's in a taxable account, you can also realize the loss and use it to offset your income or your gains in that tax year.
Okay. That's a really good answer. And so some of those stocks that fall, I guess you just kind of let them sit with, and then the risk might be, I mean, because it's not really worth it to cash out something when it's so low.
I mean, if you're going to use the loss.
Unless, to use the loss, okay.
Hold on, but I do want to say, like, kind of going back to the rise of the retail investor, this is where I have like some real problems, like making any sort of like recommendation on this, right? A bankrupt company in the long run is going away. Like it might still be trading, but that company is in the process of going through the legal process of like selling all of its milk bins for cash and paying back the people it owes money to. There will be nothing, this company will be worth nothing eventually. But like, again, with the rise of the retail investor, Robinhood investors, for some reason, love betting on penny stocks of bankrupt companies, right? So Hertz was the poster child last year. Hertz is in bankruptcy. That company is worth $0 to its owners. But still, it still trades, and it's a well-known name. So every once in a while, you'll see people buying it, and the price will spike up, right? And you're like, stop doing that. This company is not worth anything, right? So with something like Dean Foods, like that can happen, right? Where just somehow you get on the radar of people who dabble in things like that. And so maybe it's at 5 cents now, maybe it spikes to 50 cents for no good reason. It's still going to go through bankruptcy eventually. Just like that has like started happening more often. I mean, and I think for people like me, it's really irritating because I'm like, don't buy Hertz don't invest $1 in Hertz. Like it is worth $0. So stop investing dollars in Hertz, right? But if you can buy it for $1 and flip it to someone for $2, then you just made money, right? So it's like it's like a disconnect in my brain but something that does happen these days. So I would say, like with Dean, like how valuable is the tax loss write-off? If it's not very valuable, then
these are all stocks and IRAs, and so
then you don't have the
at this point. But I had this idea. Well, when it dropped to zero or almost zero, I bought more shares.
Yeah. So you did that.
Thinking it would kind of appreciate enough so that I would redeem my loss, but it hasn't happened yet.
Yeah, because it is literally worth $0. So if you pay 1 cent for it, you are overpaying, right? But you might be able to find someone to flip it to. So it might be, I mean, I don't know. I had a client who had something that was trading at 1 cent per share, and after the GameStop meme thing, it spiked to 6 cents a share. And so, I mean, on a percentage basis, that's awesome, right? Like we made like thousands of %, but I have no idea who bought these things, and it doesn't matter. Like, but we sold them, right? Like when the price spiked, like in the interim, the plan was just to like wait for them to go to zero. And eventually your broker will be like, Jeannie, this stock is worth $0. We're taking it out of your account for you, right?
Well, they could get bought out of bankruptcy because maybe something will happen and milk will become popular again. I don't know.
But not if it would make more sense for an investor to wait for them to go through bankruptcy and buy their assets from them. Right? Like the problem is not the milk company, it's the amount of debt that Dean Foods owes.
Okay.
So it owes, it's underwater. It owes more than it's worth. So anyone who wants to come into the milk space would be like, if you bought Dean, you'd be buying its debt too. You would now owe someone all of that money.
Okay.
So it makes more sense for new investors to just wait for Dean to die and then take over with a clean slate afterwards, after all the debt is.
Okay. It could be a while.
Yeah.
Thank you, Sarah.
Really good questions.
I know that Rakshanda had a point about real estate. Did you want to unmute yourself now?
Sure. Thank you, Gwen.
Yeah,
First of
absolutely.
all, thank you so much to you and Sarah for the greatest gift of time in this platform. So shout out to you guys and everybody else who
Oh, you're so sweet. Thank you.
And since we were on the and I will talk about the real estate, but I will share a simple story with you. We have time. I know we are running past the time, and I count time in 13 minutes and 12 minutes too. So here, a local investor group that was helping the minorities, more distant from some nonprofit group. But long story short, we are in an LLC with 18, 20 people, and I started back in 2006 at $50 a month, 50, and now it's at 75. The founding members are still the same, and you $50 a month, oh my gosh, you don't even miss it. And now it's 75. I kid you not, Sarah, back in 2006, we had a big party when we hit 50K mark, $50,000. And guess where that thing is sitting today? It's almost close to $1 million. Among 18.
That's awesome.
I know, it's like 770K or something. When you divide by 18 people, of course, there'll be, capital gains or loss or people coming and going fee. But point being, every bit helps.
Yeah.
Every little raindrop makes a bucket, and then the bucket makes a sea, if that makes a sense. But anyway, so I'm grateful for that. As far as the real estate, your spreadsheet was wonderful. I really like the present value and everything you did, but I don't want to take a lot of air time here, but I have an example, and coincidentally the property is 99.5K, so let's just say it's 100K, right? It's a rounding error, and it has a gross numbers as in GROSS versus the net. So gross monthly income is $995, and take home will be $741. And the cap rate is 8.9%. So we can call that as your return on investment. Like how we say, hey, stock market average is 10% over 40 years or 15. So this is the best. This is not a legal takes our accounting advice. This is just speaking from the heart, also sharing information and helping other great, wonderful ladies here. So quickly, for this particular one, it has a calculator built in. So your income will be $995 per month. Property taxes $100 to $25 a month. So times 12, but I'll go with a month since we are in the flow of the month. So income $995 a month, which is $1,000. Property tax $125. Insurance $50. HOA is zero in this case, but it will depend if you are in a HOA homeowner association situation or not. And then, am I talking too fast? Because I think fast and I talk fast.
No, but
Can
I'm
y'all hear
curious.
me?
I'm curious where the property is.
So this can be anywhere. I was just talking with the example, but it could be in Texas, Austin, Dallas, Houston, wherever, or Oklahoma, or Pennsylvania, or Ohio. I was focusing more on the numbers because I'm also a math major and, doing major. So this is just the example. I was working through all the numbers. Since this is a 100K property, of course, if it's $1 million house, 200 or $500,000, then those numbers will adjust with the percentage.
Yeah.
So continuing with my flow, management fee is anywhere from 8 or 10%. That depends if you are managing the property yourself or if you're outsourcing it. So in this case, let's say we're outsourcing it, right? Because we're all working professionals and, we don't have time to go, the Texas toilets and tenants, as they call it in this industry, okay? And maintenance reserve, 5%, HVAC is gonna break, pipes will burst like last week in Texas or something, you may need a new washer dryer or something. And then appreciation rate and vacancy allowance. So in net operating income, so basically it is a similar look and feel like your Excel sheet. Some of the terminology is different. It will depend on your risk tolerance. Now this one had a cap rate of 8.9.
Yeah.
Realistically, not every property will have it. It will be 6.6 or 4 or 12 or 13. So this is a residential, not commercial. So sorry, go ahead. I'll go on mute.
Yeah, I mean, I was just going to say that it sounds like you're reading from a spreadsheet that you have put together to make this calculation. Is this a good real estate investment or is it not? Based on all of these inputs that you have. And, obviously we can't.
So you are breaking up?
Oh, I was just saying that.
You were breaking.
Gwen, can you hear me? Am I?
You sound fine on my end.
Okay. Yeah, I think with the spreadsheet that you have, you're taking into account all of the right things, right? Like as a real estate investor. And certainly I can tell just like, the spreadsheet that you've either built or are using, it would enable you to evaluate properties to make sure that you don't fall into some of the pits that I just casually mentioned, in the discussion about which assets you choose. And certainly I think that's where I differentiate between people who are doing this as as an investment, like as a systematic investment, and people who maybe either kind of stumble into or maybe don't know the amount of work that actually goes into running an investment property, right? Because I can't see your spreadsheet, but I can hear you like going through like all of the line items, right? Like, okay, we have to account for that, we have to account for that. And so it's awesome, right? It's like how like people who are comfortable in real estate or more comfortable in real estate than in something else, it's how you end up making money, right? But it obviously takes effort. You don't just stumble into it. You're making logical forecasts and allocating your resources accordingly. So that sounds awesome.
Oh, great, thank you. And guilty is charged. So yeah, I was reading from.
It sounds like an awesome spreadsheet.
Yes, ma'am. It's a, speaking from online calculator, but also it's a long game. It's not
Yes.
if a mortgage is 15 or 30 years. So not if the term is just a marathon, it's not a sprint, right?
Right, right.
So
I
like
just want to
anything
bring up
else in life, the 15-year note. Yes.
one other human factor as someone who owns a house and a casita in Austin, but lives in California now. I didn't sleep for the 4 nights of the storm, worrying that my tenants were freezing to death. And then I've been on the phone with plumbers ever since, remotely trying to get all that done. So like on top of whatever my car issues here. So I do have to say, like, as a landlord who is dealing with 2 places, it is a part-time job in every sense of the word. And there's I can't be in a place without cell service. Like it dictates decisions I can make for my own life. That's the only thing I'm going to add there.
Yeah.
Yes, ma'am. Amen to that, sister. So I will say, as we speak, we are dealing with some, pipe bursts and whatnot. We are helping a family member. Well said, but that's why I put the management fee at 8%.
Yeah.
But like anything else, that would happen anyway, even in your primary residence, God forbid, right? Like if you had a tornado or flooding, Hurricane Harvey happens. But this was again focusing, yes, there is a human factor in all of the above. Your tolerance, risk, profit you're looking for, and money you're willing to part for how much time. But anyway, thank you, Sarah and Gwen. I don't want to take up the time, but great discussion. And who knows, we will pick it up again next time, some other.
Yes, thank you.
Thank you, Rakshanda. I think that might have also been really helpful. There were questions earlier about like real estate investments versus investing in the stock market. So just running through that exercise of like, these are all the different things to consider. They're sort of apples and oranges. So it's a difficult question. And then I think, so the last question that I did want to cover today was Claire and Amy Lynn are wondering, does it make sense to just invest through whoever manages their 401ks, or are there pluses and minuses to different companies? Is there a benefit to shopping around?
Maybe. That's a really good question. So the largest employer-sponsored plan company, I think, is Fidelity, right? So Fidelity and Schwab really kind of like own a lot of that space. And so I think that when I'm thinking about investing in stocks or bonds or mutual funds or ETFs, Schwab, Fidelity, basically the same, probably no difference in, no reason to shop around if they're one of your custodians. When different, there might be other firms. The firm that is your plan administrator for your employer plan might be a firm that is slightly more expensive than a place like Fidelity or Vanguard or Schwab. I think of Fidelity, Vanguard, and Schwab as like super ultra low cost. Relatively, Schwab and Vanguard are like relatively consumer friendly. I mean, like user friendly, like their website. Fidelity, not so much. But sometimes you have like other companies that if you opened your investment account there, you might have salespeople calling you to sell you mutual funds, or the mutual funds that are offered might be higher cost, or they might charge you a commission to buy and sell, to trade. So I think that's really kind of the main differentiating factor. I don't think that there's a minuscule risk of having all of your accounts at one place, if that place is like kind of one of these big, huge Fidelity, Schwab, Vanguard types of places. Those companies aren't, they're not going to go bankrupt. And even if they did, your accounts wouldn't be at risk. So if the question is like, is there a risk to having all of your accounts with one custodian? I think it's like basically no, there's always some risk, right? There are no guarantees, but that would not be the risk that I'd be concerned with. Certainly, I think it's riskier to have accounts at all different custodians because you can't keep track of them. Like that's what I see way more often. Is like someone's like, oh, I totally forgot about this account, that I started 10 years ago and I haven't looked at it since, and it's been sitting in cash or something. or Dean Foods, right? It's been sitting in something that whole time and I forgot about it, right? So I think like keeping things manageable is a priority. Keeping things manageable and inexpensive is like two good priorities to have. Did that answer that question?
She says yes.
Cool. Oh my gosh, great. Oh, these were great questions. Thank you everyone who participated, everyone who chatted, everyone who helped out your fellow members in the chat box. I do think I'm gonna have to head out. It is 4:51, but again, we'll post this on the YouTube page and send out a link so that you can come back or forward it to other people who you think might be interested. And next month we are going to talk about budgeting with Sandy Coco. So it'll be really great. I think she does her budgeting with Excel, which is my jam, right? I'm really excited about that. So we will send out that invitation as soon as we solidify the plans. And in the meantime, let us know.